Dan Geltrude is here to break it down for us. He's a financial analyst and founder of the accounting firm Geltrude and Company. So, Dan, talk to us about the fact that inflation is high and why that might mean that it's a good time to open a CD. Who should be considering this?
Sure. So when you have a situation where there is still inflation that remains sticky, it's still too high, the federal government, specifically the Federal Reserve, is reacting to that by not lowering interest rates or potentially raising interest rates. What does that mean? Well, that's bad for borrowers because it's more expensive. However, it's good for savers. Why? Because investors that are risk adverse, those that really don't like the chance, have the opportunity to put their money into a CD for some specified period of time at a locked-in rate, so they know exactly what they're going to earn on their money. And this is a very good thing for those that are like to save, risk-free.
So let's talk about the rate lock component of a CD. Given that there still is the belief that these interest rates are going to come down, that eventually the Fed is going to start cutting rates, what happens to a CD when you've invested it for a set period of time, let's say 5 years, and the Fed then decides to cut rates?
Well, once you've locked into the rate, whether it's 1 year, 2 year, 5 year, whatever that period of time, that rate is guaranteed. So what you do is you take all the risk out of interest rates going lower. And yes, the assumption is at some point inflation will recede, and therefore the Federal Reserve will start to lower interest rates. And that means that in CDs going forward, you will earn less interest. But once you've locked in, you're guaranteed that rate. And again, that's very comforting for many risk-adverse investors.
Dan, let's talk about being risk adverse, because the market right now outperforming even the best CDs. If you're looking at a CD of 5%, even 5.5%, who should opt to invest in CDs, and who should opt to actually put their money in the markets or other investment opportunities?
Well, to begin with, you kind of have to have the stomach, for lack of a better term, to be in the stock market. So look at what happened this week. We got these CPI numbers, the inflation numbers, and they were higher than expected. The result of that, the market came down, stock market came down significantly. So yeah, there were gains that people had that they lost on. Not if they didn't sell, but the value of their portfolio went down. On the other side of it is that those that were locked into CDs, it was of no consequence. So in terms of who should be investing where, well, those that are going to put their money into the market, those are the people that say, hey, I'm going to be in for the long term. I don't need to pull that money out, and therefore I can get the long-term benefit of what the stock market offers.
Yeah. All right, Dan Geltrude, thank you.
Thank you.